Hello and welcome to another video on REITs by reitspro.com, place where we give you lots of insights on REITs and InvIT investing in India. Let's talk about debt. Is it a bad word for REITs and InvITs? Is it really so? That's what we'll explore. But before that, we'll first try to give to some users who are not yet familiar with REITs and InvITs what are REITs and what are InvITs. They are basically an upcoming quasi-equity financial asset that is SEBI regulated. They have assets which are held either as real estate or as infrastructure assets. Secondly, they invest in completed revenue generating assets majorly. They have to pay out 90% of their cash flows essentially. And REITs, we have four REITs and 3 public InvITs today in India whose shares trade like normal equities. And if you really want to understand much more, do visit our website, reitspro.com, and look up the free resources. There's also a WhatsApp chat group. You can visit the site and have a look at all these. Additionally, please subscribe to our videos because we are, in fact, the first dedicated REIT and InvIT channel for India. And for much more content in the future, do subscribe to our videos. So the topic today is debt is good for REITs and InvITs in India. And this is Gaurav Jain. I am an author and a trainer, and these are the 2 books you can see when you visit our website or on Amazon. We would start with saying that if you are buying a property, you do take a hefty loan, don't you? A lot of people take hefty loans when buying a residential property or even a commercial one. Additionally, infrastructure projects, there's a large portion which is debt funded. That is what we could probably replicate when we go on further in our video. So the REIT leverage currently as far as the Q2 2024 is as follows. And there are 4 REITs today: Brookfield, Embassy, Mindspace and Nexus, with their respective leverages which are given here. Now these are loan to value ratios, loan to the assets under management. We'll explain a little more on that a little later. However, for a full analysis of this, you can also look at this video we had some time back, and that's where we covered a lot of other aspects also. Now, the video today is in 3 parts. So we'll cover the first part right now, which is the debt in REITs concepts. So that is what we would cover right now, and then go on further to the part 2, which is case of InvITs. Then we'll take a case of PG InvIT versus Indigrid, how they've handled their debt part. And third, the cautions to be exercised when we look at REIT and InvIT debt. What are the cautions? So the first part is about the basic concepts in debt in REITs. So if you look at the debt, that's considered differently as far as REITs are and InvITs are concerned. So there is a different metric that can be used. In normal corporations, we have debt to equity, whereas in REITs, we have debt to asset value. So there are differences in the basic way that you view debt in a normal corporation compared to REITs and InvITs. In normal corporations, you have debt to equity ratio, and it is calculated as debt to the equity, which is again total assets minus debt. Now, this obviously incorporates changes in balance sheet over the year. And in case of REIT corporations, you have something called the debt to value of assets. So mainly completed assets are in a REIT and InvIT, and the assets are valued by a valuer periodically. And if you look at the total asset block, let's say if the value of the total assets in a REIT is X rupees, then these are assets that are valued by valuers periodically, and a part of it, which is debt, is then considered as a percentage of this total asset block. So just to explain further, so if you have Brookfield at 34%, that the total value of the assets of REITs as valued by a valuer periodically would be 100, and Brookfield would have 34% of that as the leverage, the debt that they hold. Similarly, Embassy, Mindspace and Nexus as given here. So unlike normal corporations, what's the difference? The first difference is that there are no new projects which have a risk of completion. So that's a very big positive when it comes to a debt in REIT. But these are actually operational and rent generating revenues. assets. So these assets are generating revenues already. So that's a very big uh, change from normal corporations, where if you look at the graph here, you will see that the left hand side is a graph of a normal corporation where some money is initially invested, then you earn money on that, you plow in the earnings and you invest more. However, in the case of a REIT, what you do is you invest your money in assets, you earn money on that by way of rentals, and you distribute more than 90% of it. And since you don't have anything retained, uh, majorly is distributed, you raise additional funds by way of equity or debt and buy more assets and again do the same thing. So this is the basic difference between a normal corporation and a REIT. And the fact is, the assets that are taken have to be value accretive. Now, the SEBI guidelines also state on debt that REITs have to have a capping of 49% of the asset values as the capping, and InvITs 70%. They could finance their debt in any of these ways. Now, a very big saving for any REIT or InvIT is that, say, debt costs them 8% per annum. Now, and the SPV, which holds the assets, pays 35% tax. Then the effective cost of debt that works out is something like this. Assuming that 35% is paid out, you have 8% into 1 minus 35%. So approximately 5.2% is the kind of, the cost of the debt that comes effectively. And this is why if you take assets more on debt, if you have the safety margins and you have a value accretive asset, it could be very good for the existing shareholders, provided it is done right. So you could also say, what about the increased borrowing costs, the cost of debt going up? When the for example, in an interest rate cycle which is going up, then at that time the cost of debt would be going up. Well, in case of InvITs, it depends, because inflation would normally inflation would push up the interest costs. And for an InvIT, for example, you have an InvIT like an IRB InvIT where the tolls are inflation linked. So, but in case of some contracts which are fixed in nature, in case of InvITs, that could be detrimental. Say in case of REITs, inflation and rent would have a positive linkage. So this we've explained in earlier videos, but this does not work out immediately. It takes time to work out. Now, coming to the second part, we see the case of PG InvIT and Indigrid InvIT. Now, both these InvITs are into power transmission assets, and both are listed and publicly traded. And if you look at the PG InvIT, it's a small case study we've done here. So PG InvIT has practically no debt, whereas Indigrid InvIT has more than 60% debt to AUM ratio. This is a snapshot of what Indigrid is doing right now. So the M&A updates for Indigrid, like we've just explained, that they need to raise capital for additional acquisition of assets. Now, over the past few months and over the years of its existence, it has completed a lot of acquisitions. So it has expanded its portfolio to about 3 times from what it started with. Now, here, for example, recently it did an acquisition of Recent Industries, which is into renewable energy. And the objective was to increase the yield from the underlying Indigrid portfolio. So the idea was to do that, and for that it funded it by both debt and equity. All these acquisitions have been done by preferential allotments, reaching out by rights issues, or by way of loan. That's how they have gathered the capital to make all these acquisitions. Now, and this leads us to a fact that the total enterprise value of Indigrid today is 27,000 crores, and this is in Q2 24. And additional assets, the objective has been to take value accretive assets so that the cost of funds becomes lower with more debt. And however, in case of PG InvIT, what has happened is that they have a enterprise value of 8,600 crores and almost no debt, about only 1%. Now, in this case, they have a lot of headroom for debt. But what has happened is that they have had a flat distribution curve. However, in case of Indigrid, there have been efficient use of debt by leverage, which has resulted in a DPU or the distributions going up over a period of time. And these acquisitions, if you see this graph, the acquisitions are in this color, and these have actually pushed up the distributions, the acquisitions, which have been implemented by raising capital, which also includes a lot of debt, which makes it go up to about 60%. Now, let's come to the third part. What are the cautions to be exercised? So the first caution is that there could be stressed revenues, because obviously loan servicing is required. So if you don't have value accretive assets, or there's something goes wrong, then servicing that would be difficult. The chances are less, because obviously the cash flows are almost predictable, not totally, but almost. Similarly, stress on the asset itself. So for example, there could be distress sale. This we should elaborate a little more here. Let's say you pick up the Indigrid InvIT, again, the part from their presentation, you have a repayment or refinancing schedule. So we see that over a period of time, there would be repayments and refinancing of the loans. So both InvITs and REITs take loans and take assets, and then obviously there is a repayment time. In case of Embassy also, for example, you see this chart where there is a staggered debt maturity chart which is given, and the debt composition is also there. So obviously there is a time period within which loans have to be repaid. Now, suppose at the time of repayment of the loan, they have to get more loan, and they are not able to get it. What would happen is that it will create a stress on the asset. So that asset itself would require, some asset would require to be liquidated to pay back that loan if they're not getting any loan. So that could be a problem if you don't have a buyer in the market, if they don't, and the loan doesn't get financed. But that's a very low probability as it seems today. And the third very big caution could be the fact that we've just seen that the debt to value of the assets is what is taken. So this is mainly completed assets, and assets are valued by valuers periodically. What if the asset values go down? So since debt is a percentage of the assets, so for example, let's just, for a hypothetical, say, today the Indigrid InvIT is 100 rupees of assets and 60 is the loan. What if the valuation comes down to 18? Then that could be a dangerous point, but that is a very rarest of rare cases probably that could happen, but still a caution that one should look at while investing. So thank you so much. If you have any questions, do write to us, do like and subscribe to our videos. Thank you.